Hello guys, welcome back to Profit Quest Unit 5. Today we'll be completing Unit 5 by talking about Module 3. My name is Adesh Kandapan, and let's start the lesson. So last time we talked a little bit about how to analyze the stock market. So when you want to buy a stock, when you want to sell a stock, a widely realized myth about stocks and how to actually prevent belief in that myth, and some of the tools that you can use, but not the only tools that you can use to predict stock activity. So today we're going to be talking about dividends and the different types or the different manners in which someone can buy stocks. So dividends are a portion of a company's earnings that are distributed to shareholders. So that means by every set period by a company, if they offer dividends, buyers of stocks could get a payout in cash or more stocks depending on the proportion of stocks that they own. So someone that earns less stock, that has less stocks, would earn less in dividends than someone that has more stocks. And there are two ways that a company can pay dividends. They can either pay cash dividends, so literally just giving these shareholders money, or they can pay stock dividends, which means the shareholders are getting more money in the manner of gaining more stocks. And dividends are paid at the end of a set term that a company usually defines to shareholders. So, for example, if a term of a company is like 4 months, then a dividend would be paid to shareholders every 4 months in cash or stock. Now, let's get into the different types of stock. The first ones are actually the most basic ones, and these are common stock. And this is what we've been talking a lot about, which is just ownership in a company. And you might also have voting rights within, like the board of that company, if you own a specific amount of stocks in proportion to the amount of stocks that the company actually has. So if you own a high percentage of stocks, you'd have more influence. So there's three types of income stock or common stocks that we're going to talk about today: income stocks, growth stocks, and fractional stocks. So income stocks are actually shares in company that pay regular dividends to shareholders, and these are the most basic stocks, which ultimately means that if you buy stocks of the company, you're going to get a dividend proportional to the amount. You're going to get an income proportional to the amount of stocks that you have. And the dividends that you get, if paid in cash, would be subject to tax before you actually get the full income. But income stocks provide dividends, and not all companies provide dividends, but usually bigger companies would pay its shareholders dividends. Another type of stock is growth stocks, and growth stocks are shares that investors have predicted are going to grow exponentially in the following years. So that means you're going to want to focus your investment portfolio on buying more stocks. And if you don't know what an investment portfolio is, it's basically just an overall, review of the stocks that you have in your ownership. So growth stocks provide a sort of way or a sort of assurance that these stocks are going to increase in the future and thereby double or triple or quadruple the money that you put into them. And finally, a type of stock that people buy are fractional stocks. And these are actually a fraction of a whole stock. So instead of buying one stock in a company, you could buy half a stock or a quarter of a stock. And this could happen when a company's stocks are at an extremely high price. So once they're at an extremely high price, if you want to buy stock in that company because you think there's potential for growth, but one stock is at a high price, you can just buy a part of that stock so that you actually own some influence in that company to gain money. Now, another type of stock is known as a mutual fund. And a mutual fund is when a lot of people invest their money into a pool, and then a professional stock manager uses the money that's invested in that pool to invest in a lot of different stocks. And mutual funds are pretty good for investors because they allow for a simple way to spread out your money over a large amount of stocks and allow for your money to be managed by an investment manager rather than being managed by yourself, especially if you are not a professional manager. Now, there is a downside to most mutual funds, as in mutual funds, since you have a professional stock manager managing your money, you would have to pay fees to account for the work done by the stock manager. So this might be 2% or 3% or maybe even more or less of the money that you invest into the mutual fund. And this causes some people to stray away from different types of mutual funds and go for index funds, which we'll talk about later. So a few types of mutual funds are equity funds, which is when the money pooled goes straight towards equity instead of the money pooled goes straight towards equity, which means the money pooled goes towards a wide range of stocks in companies. Bond funds, which means that the money pooled goes towards buying debt from other companies. So if you don't know, if you remember in Unit 3, debt increases due to the interest on that debt. So it's not just the capital that you're buying, but you'd also be buying the interest of debt. So you could buy debt at a lower cost than the actual face value from a company that owns someone's debt. And then now all of that debt would have to be paid back to you. And you bought that debt for only maybe half or 75% of the capital amount. And then once that debt has to be paid back to you, you have to get that money back from the people that owe you debt or from the organizations that owe you debt now that you own their debt. So now that you own their debt, you might hire a third-party agency to get your debt back, which would ultimately be an increase for you because you're profiting off of other people's debt. And then since you invested your money in this bond fund to buy other people's debt, the money would start to be spread out between the people in the bond fund, and depending on how much money you put into the bond fund, you would get a proportional amount of money out. So these people would be paying their debt back, which then goes towards you. Now, money market funds and balance funds aren't really important, but balance funds are kind of a mixture between equity funds and bond funds, where you're buying bonds and equity. And money market funds are investing in cash and, more debt and even government securities. But both of them are also mutual funds, as it pulls money from investors and then uses that money to buy what I just said. And then finally, index funds. So in the 1900s or 2000s, I'm pretty sure it's in the 1900s, a certain businessman got tired of paying stock managers these high amounts of money to buy stock in these mutual funds. Even if the stock market crashes for the index fund or for the mutual fund, then you still have to pay the stock managers money. And someone saw this as a scam. So they created the S&P 500 index fund. So what are index funds? So index funds are a type of mutual fund. And what it does is it has an algorithm that replicates the flow of the market. So when you invest your money into an index fund, you're actually spreading it across many different stocks that's already been calculated for with an algorithm so that your money is going through all of the stocks of this company, but you don't have to pay money to specific you don't have to pay money to specific active fund managers. So it's much less costly than other types of mutual funds, but it is still a type of mutual fund. So some of the benefits are more diversification. So you have less risk in your overall portfolio. And if you guys don't know what diversification is, it means that your portfolio has its money spread across multiple stocks in multiple companies. And that could provide less risk, as if one of the stocks that you've spent your money in crashes, then that can be made up for by the growth of other stocks in your portfolio. So diversification, oh my god, is good as it lessens risk upon your funds. And additionally, there's no active fund management, so it provides for a lower cost for you to get your money out on the stock market, as the funds that go into the index fund are managed by an algorithm, which means it's passively managed. So there's no active fund manager actively moving your money around. And some of the most popular index funds are the Vanguard 500 index fund and the S&P 500. I don't know why that's on there twice. That's a mistake. But yeah,